You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, to say the markets have been seesawing around lately would be an understatement. Basically, if you were asleep on Monday and you did not pay any attention to the news, you would have not known about the fact that the markets were at one point in time in the Dow Jones Industrial Average down 1,000 points and finished flat on the day. Kind of crazy, a mini flash crash, if you will, but only to wake up on Tuesday and have a very similar type marketplace overall. One of the things that I did note at the beginning of this week, and I should let you know that that we are taping Options Playbook Radio on the 26th of January. It is a Wednesday. The markets today in the S&P 500 index were down 6 points, trading at $4,349.93. We did actually have the NASDAQ up today. Now, a little bit of a different pattern overall is that today the markets were kind of flat to up a little bit and ended up down on the day, kind of reversing the pattern, but not down a ton. And to go back to the point on Monday, we did see the VIX actually skyrocket up to around just below the 40% level. And we haven't really breached the 40% level that many times since the pandemic, which is almost 2 years old now. In March, it'll be 2 years old, the big downturn that was caused by the pandemic. And so when you see that type of a move in the Dow, you expect the VIX obviously to go up. I kind of expected the VIX to break through that 40 level this week. And yeah, we went down, we came back. The VIX is still trading above 30. Right now, it actually closed at 31.96, up 80 cents on the day, or relative to the beginning of the week, basically up nothing relative. But 31.96 will round it off to 32. I really thought that VIX might be pushing through the 40% level. I thought everybody was going to be heading for the fallout shelters, waiting for the Fed to speak, and the Fed was going to save us. There was a little bit of that today. We did get some Fed speak, and that news is out. The tone of the conversation was more important than the meat of the presentation, if you will. overall. But now that that news is out, I do expect the VIX index to come in a little bit more as we go into the end of the week. But we still have a ton of earnings. So not only did we have this volatility that was probably more so caused by the scare of inflation, the scare that the Fed might be raising interest rates quicker than anticipated or that the market was thinking. And a lot of those things have subsided overall. So I expect a little bit of the volatility to come in. But with that said, when you're in a world where inflation is a concern, the actual volatility, I do anticipate to continue as we head into the summer. So last week, we talked about a bear put spread in the S&P 500 index. And guess what? That spread made money. Go figure. We did a very short-term bear put spread. And we're going to do something similar today. We're going to do it based off our earnings. We got a lot of the FANG stocks that are going to be announcing earnings, some of the favorite stocks that we like to talk about here on Options Playbook Radio. And it's not a favorite in that we just like the FANG stocks and we think these are the best stocks to trade in the marketplace, yada, yada, yada. It is more so that in the FANG stocks, there's volume. And when you're an option trader, you want volume. You need a lot of volume in the stock to make sure that the options are liquid enough to be able to trade. And the FANG stocks, Facebook, Apple, Google, Netflix, these are the stocks that have volume, and because of that volume, they're enticing to trade options on. So whenever they're announcing earnings, we usually try to take a speculative trade. Nothing's ever meant to be a recommendation. We're just trying to learn. So we're going to take the themes of last week's trade where we were getting a little bearish in the marketplace. We decided just used an index option to be bearish short term. And as a matter of fact, I think we did Options Playbook Radio as usual after the close on a Wednesday. On Thursday morning, the market actually opened up for a minute or two up until about noon, and then the market started to go down, and then Friday it closed down, and that trade would have worked out just fine. We weren't looking for a big move to the downside. We were just looking for a momentum-based trade to the downside, and that's what happened. So if you would have hung around until Friday on that trade, you would have made the maximum on it. Now, this week, we have Apple announcing earnings. They're going to announce after the close tomorrow, the 27th. So I'm going to do the same type of trade. We're going to do a bear put spread in Apple, and we're going to manage our risk by going just a little bit in the money and selling a little bit out of the money. First of all, if we're going to do anything around earnings, we always want to know what the expected move is. And we don't want to move too far away when we're looking to basically just do a coin toss trade in Apple, right? We want to make sure that if we are doing a bear put spread, that the strike that we are selling, the expected move says, well, yeah, I think we can get to that strike. Basically, the marketplace would be saying that. It's another way to approach it. So in this instance, with Apple closing today at 156.69, let's call it 160. If you bought the at the money put, the 160 strike put, and the at the money call, the 160 strike call, the midpoint is about 760 for that overall. That means that we really don't want to go much more than $7.60 away from the current strike price of 160 or where the current market is at. It's about a 5% move. I guess in general, I've done a lot of just little speculative trades around Apple, around earnings, and 4 or 5% is the norm. So this isn't too crazy, even though the VIX is trading around 32, that we're going to see Apple trading around 5% expected move after they announce their earnings. So not too shabby, but we want to make sure that we stay within that range. So what we're going to do is we're going to go a little bit in the money on the put that we're buying. We're going to buy the 162.50 strike put. And then we're going to go a little bit further out of the money on the one that we're selling, but still within the range. We're going to go about 5 points down. Remember, the expected move is 760. And so we're going to go 5 points down. So we're going to sell the 155. And we're going to do this. This is going to be a one-day trade. It's going to be all or none. So we want to manage our risk by the amount of debit that we're paying. And when you go a little bit in the money and you sell a little bit further out of the money, that means that you're going to pay less than you're going to have less risk and you're going to have more reward. So in our instance, and I'm going to round off here, the midpoint is at very close to $290. So $290 for every 1-by-1 spread that we're doing. It's going to expire on Friday, January 28th, after the earnings announcement. And that means it's a 7.5 point wide spread. So we're paying $290 for it, 7.5 points wide. The maximum upside is $4.60. And if I'm going to do speculative trades, this is one of the wonderful things about spreads, is that if you put on this trade, you can totally manage your risk versus your reward. So I'm going to go in and say, I'm willing to risk $3, but if I'm willing to risk $3 on a 1-by-1 spread here, or $300 plus commission, then I want to make sure that I can get more upside than $3. I don't want to risk $3 to make $3 necessarily in this instance. So if I'm going to do this trade, I want to give myself a little bit more upside on the trade. And that's how we have this set up. So if I'm doing this, I know that this $2.90, which is the midpoint right now, is the maximum that I can lose on the trade. And I got to be willing to lose that, right? And that's basically means that if Apple came out with earnings and was perceived as good, well, then the market should move up above the 162.50 strike. And then you have 1 day remaining to that expiration date. Odds are high that you will probably not have anything to sell when it's all said and done. And honestly, I would probably just let it ride anyways. And if it goes down, the expected move says, well, you would expect it to move at least $7.60 or around that amount. And then hence you're hoping to get down at least 5 points down to the 155 level. And once again, you ride it to the end and you try to make the maximum on that trade overall. Now, at some point in time, if you are in the trade and Apple only moves, let's say $3 or $4, and let's say it moves in our direction, well, yeah, you can close out the trade. Anytime after the noon hour on Eastern time, I would consider closing the trade. I really don't want to ride it. I don't want to be in the position at expiration, so I'd rather close a trade than worry about exercise and assignment. And if I end up somewhere in the middle between the 162.50 strike and the 155 strike, that can be an issue, right? Because one of your options is in the money and the other one is not. So you want to make sure that if you do these type of trades, that you usually close them out at the end of the day, no matter where they're at. And always be willing to give up a dime or a nickel to do that trade, because we're looking to make dollars on this trade as opposed to worried about nickels and dimes overall. That's not the goal of this trade. We're not selling credit spreads way out of the money or that type of scenario. So that's what we're looking at. So let's go back and review the trade. Okay, so we had a down day overall we've had a down day in the S&P 500 index and the NASDAQ overall. There were much worse periods in the marketplace. The VIX is up above 30 because of some of the angst in the marketplace. A lot of it has to do with inflationary concerns overall and the fact that we are in the middle of earnings season. And so we're going to just kind of ride this wave a little bit. And we're going to, even though Apple is a stalwart in the marketplace and has sold off a little bit recently, it was one of the things that was holding up the NASDAQ. But now at this point in time, Apple has given up a little bit of its gains. It's trading quite a bit below its all-time high at this point in stage. We're going to take a bearish view because we haven't been that bearish on Options Playbook Radio. Hasn't been a lot of reason to be bearish over the last year. And we're going to look at a bear put spread in Apple with 1 day remaining to expiration. So if you put the trade on tomorrow, you'd want to put it on a little closer to the close because we're really just trading earnings. But as of right now, we are looking to buy the January 21st expiration 162.50 put at the same time. Sell the January 28th expiration 155 put. Looking to get it done for a net debit of about $2.90. That's $200 and $290 plus commission would be our maximum risk on that trade. And then on the upside, it's a 7.5 point wide spread. So the maximum it could trade for is 7.5. 7.5 minus 290 is 460. So we have $460 less commission of upside on this trade. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle's @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.